Hey there everyone, and welcome to Insurance 101. I know, probably not the most thrilling title for a YouTube video, but trust me on this one, because understanding insurance, like really understanding it, is about understanding one of the most fundamental aspects of, well, existing. We're talking about risk, and not the fun kind, like should I try this new flavor of ice cream? Risk, but the kind that shapes decisions big and small, from buying a car to, well, just about anything. Today we're diving deep into the world of insurance, unpacking the 28 key concepts you absolutely need to know. This isn't just about passing a test. This is about empowering you to navigate the often confusing world of insurance with confidence. Let's kick things off with a concept that's as fascinating as it is important: adverse selection. Imagine this, you're an insurance company, you want to insure as many people as possible, right? Makes sense, more customers, more money, but here's the catch. Not everyone is the same when it comes to risk. Some folks, maybe they're super careful, they eat their vegetables, they look both ways before crossing the street, they're just statistically less likely to, need to use their insurance. Then there are those who live life on the edge, a little more accident prone, let's say. Adverse selection is all about what happens when those more likely to actually need insurance, those living on that edge, are also the ones who are most likely to buy it. It's like knowing you have a lead foot and still opting for the cheapest car insurance. This can be a real headache for insurance companies because it messes with their whole risk calculation game. So, we're talking about risk. But what exactly makes something risky in the eyes of insurance? That's where hazards come in. Think of a hazard as anything that increases the possibility of a peril, which is just a fancy insurance word for the thing that causes the problem actually happening. Let's say you leave a lit candle next to a stack of old newspapers. Fire, that's the peril. But the hazard? That's leaving the candle unattended near flammable stuff. It's the setup, the condition, the thing that makes the fire more likely. Hazards can be physical, like a slippery floor, or they can be a bit more, shall we say, human. Now, insurance companies, they're not in the business of just randomly handing out money when bad things happen. They're all about calculating risk, and a big part of that is grouping similar risks together. That's where homogeneous exposure units come in. Think of it like this. If you were an insurance company insuring cars, you wouldn't lump a shiny new sports car with a beat-up old truck, right? They're both cars, sure, but their risk factors, their likelihood of getting in an accident, needing repairs, all that jazz, it's totally different. Homogeneous exposure units are all about finding those groups of things, whether it's people, buildings, whatever, that share similar risk profiles. It's like putting all the careful drivers together and all the, shall we say, enthusiastic drivers in another group. It helps insurers spread the risk and set premiums that actually make sense. Chapter 4. Indemnify, making you whole again, financially speaking. Okay, let's say the unthinkable happens. You have a fire, a car accident, a rogue squirrel rampages through your living room. Whatever the covered disaster may be, this is where insurance steps in to hopefully make things right again, and by right, we mean financially. To indemnify someone means to restore them to the financial position they were in before the loss occurred. It's not about profiting from insurance, it's about getting back to where you started, financially speaking. Chapter 5. Indemnity. Putting a price tag on making it right. So we know that insurance aims to indemnify, to make you whole again after a loss. But how do you actually put a dollar amount on that? That's where the concept of indemnity comes in. It's the specific amount of money needed to get you back to your pre-loss financial state. This can be a bit tricky to calculate, of course, because how do you put a price tag on sentimental value? But that's a whole other video. Chapter 6. Indemnity contract. The fine print that matters. Now, we can't talk about indemnity without talking about the contract that makes it all happen. The indemnity contract. This is the big kahuna, the document that outlines exactly what the insurance company will and won't cover, and how much they'll pay out in the event of a covered loss. It's super important to read this carefully because, well, it's kind of the whole point of having insurance in the first place. Chapter 7. Here's a fun fact. Insurance companies kind of love math. Okay, maybe not love, but math is definitely their secret weapon. Specifically, it's the law of large numbers that makes the whole insurance thing possible. This law basically says that the more individual risks you group together, the more predictable the outcomes become. Think about flipping a coin. Flip it a few times and it's anyone's guess how many heads or tails you'll get. But flip it a million times, the results are going to get a lot closer to a 50-50 split. Chapter 8. All right, let's talk about the elephant in the room, the thing we all hope never happens, but are kind of prepared for when it does: loss. In the insurance world, a loss is simply a decrease in the value of something as a result of a peril. It's the car that's now a crumpled mess after an accident, the house that's damaged by fire, the phone that took an unfortunate swim in the toilet. Chapter 9. Loss exposure is a bit of a downer to think about, but it's a crucial part of understanding insurance. It's basically the risk, the possibility that a loss could happen. We all have loss exposures, whether we realize it or not. Owning a car means you have a loss exposure related to car accidents. Owning a home means you have a loss exposure related to fires, floods, break-ins, you name it. Chapter 10. Loss exposure unit, breaking down the risk puzzle. Loss exposure is the big picture. It's the possibility of something bad happening. But loss exposure units, these are the individual pieces of that puzzle. Each person, each building, each possession that's exposed to a potential loss, that's a loss exposure unit. Chapter 11. Moral hazard. When good intentions go bad. Moral hazard is a tricky one. It's not about being a bad person, but it is about how having insurance can sometimes change our behavior, even if we don't realize it. It's the idea that if we know we're protected, we might be a little less careful, a little more willing to take risks. Think about it. Would you be as careful with a borrowed phone as you are with your own? Chapter 12. Morale hazard. The "it's insured, I don't care" attitude. Morale hazard is a close cousin to moral hazard, but there's a subtle difference. While moral hazard is about subconscious changes in behavior, morale hazard is more about a conscious disregard for risk because, hey, I have insurance for a reason, right? It's the "I don't need to lock my car, it's insured" mentality. Chapter 13. We've talked about hazards, the conditions that make a loss more likely, but what about the actual event that causes the loss? That's the peril. The fire, the flood, the earthquake, the theft. These are the perils that insurance protects against. Chapter 14. Remember hazards, the things that make a loss more likely. Well, physical hazards are the ones you can actually see, touch, or trip over. Think icy roads, faulty wiring, a tree growing too close to your house. They're tangible things that increase the chance of a peril occurring. Chapter 15. The world of insurance can get pretty complex, with multiple policies sometimes covering the same thing. That's where understanding primary insurance companies is key. The primary insurer is the one that takes the first hit, so to speak, when a claim is made. They're the first ones on the scene, figuring out what happened and how much they're responsible for paying out. Chapter 16. Pure risk. Where insurance feels right at home. Insurance isn't about gambling, it's about protecting against loss, and that's why it deals primarily with pure risk, the kind of risk where there's no possibility of gain, only the chance of something bad happening. Think of it like this. A house fire is a pure risk. You could lose your home, but you're not going to magically end up with two houses. Title reinsurance, insurance for the insurers. Ever wonder how insurance companies protect themselves? It's not like they can just call up a bigger insurance company when things get dicey. Well, they kind of can, and it's called reinsurance. Basically, it's insurance for insurance companies. They pay another company to take on some of their risks, so they're not totally wiped out if a major disaster strikes. Title reinsurer. The insurance company's insurance company. Reinsurance is the act of sharing risk, and the reinsurer is the one who steps up to the plate, willing to take on some of that risk from the primary insurer. They're the ones with deep pockets and a high tolerance for risk, the kind of company that doesn't flinch when a hurricane threatens to make landfall. Risk is at the very heart of insurance. It's the uncertainty of loss, the possibility that something bad could happen. We all face risks every day, from the moment we step out of bed to the moment we fall asleep, hopefully not face first into a bowl of cereal. Sometimes the best way to deal with risk is to just avoid it altogether. That's risk avoidance in a nutshell. It's choosing not to participate in activities that carry a high level of risk. Don't want to get in a car accident? Never get in a car. Risk management is all about being proactive, about identifying potential risks and then figuring out the best ways to handle them. It's not about eliminating risk entirely because, let's face it, that's impossible. It's about understanding the risks you face and making informed decisions to minimize their potential impact. Risk reduction is all about taking steps to decrease the likelihood or severity of a loss. Think of it like this: you can't prevent earthquakes, but you can reinforce your home to make it more earthquake resistant. Sometimes the best way to manage risk is to just accept it. That's risk retention, the decision to bear the financial burden of a potential loss yourself. It's often associated with self-insurance, where you essentially become your own insurance company. Insurance companies don't just hand out policies to anyone who asks. They have a whole process for deciding who they're willing to insure, and that's called risk selection. It's about analyzing your risk profile and deciding if you're a good fit for their insurance products. Risk sharing, also known as risk pooling, is a fundamental concept in insurance. It's the idea that by pooling our resources together, we can all share the burden of risk. It's like a giant financial safety net woven together from the premiums we all pay. Risk transfer is the name of the game in insurance. It's the act of shifting the financial responsibility for a potential loss from yourself to an insurance company. You pay your premiums, and they agree to cover the costs if something bad happens. Self-insurance is a bit like being your own insurance company. Instead of paying premiums to an insurer, you set aside money yourself to cover potential losses. It's a risky strategy, but it can make sense in certain situations, especially if you have a high risk tolerance and a healthy emergency fund. Remember how we talked about pure risk, the kind where there's only the possibility of loss? Well, speculative risk is the opposite. It's the kind of risk where you could lose, but you could also win big. Think gambling, investing in the stock market, starting a business. And there you have it, 28 key concepts that are essential to understanding the nature of insurance. We've covered a lot of ground, from the basics of risk and loss to the intricacies of insurance contracts and risk management techniques. We hope this video has been informative and helpful. Whether you're just starting to learn about insurance or you're a seasoned pro looking for a refresher, understanding these key concepts will give you the knowledge and confidence to navigate the world of insurance with ease. Don't forget to like, share, and subscribe for more educational content. Thanks for watching.